Competition is always a risk factor, but nothing tests the strength or weakness of a company's competitive position like tough times. The airline industry certainly had difficulties in 2007 and 2008. Fuel costs were one big problem. The average cost of fuel rose from $1.75 a gallon in February 2007 to $3.82 a gallon in July 2008, an increase of 118%. Then the recession hit in the second half of 2008, and traffic dropped, driving U.S. airlines from a $4.4 billion profit in 2007 to a $3.3 billion loss in 2008. How do tough times affect competition? Who gains and who loses? Let's use this grid to portray a company's competitive position. The vertical scale shows how fast a company's market share is growing, measured by the change in share over the last 12 months. The horizontal scale shows how profitable the company is, measured by operating margin. Companies with the best competitive positions are to the upper right. Companies with the worst are to the lower left. In 2006, American Airlines had revenue of $20.6 billion, an operating margin of 5.1%, and market share growth of negative 0.4%. Southwest Airlines had revenue of $9.1 billion, an operating margin of 10.3%, and market share growth of 10.4%. Normally, size is a big competitive advantage. Bigger competitors usually have more bargaining power, greater economies of scale, and other important advantages. But not always. Southwest is less than half American's size, but it has operating costs 30% below Americans, and that's the source of Southwest's competitive strength. How well did Southwest do in 2007 and 2008, when fuel prices and economic problems began to hurt the entire industry? Was Americans' size an advantage when times got tough? In 2007, American began losing market share at a faster rate. Its share growth fell to negative 3.7%, and the company's operating margin fell slightly to 4.9%. Southwest also felt the pain. In 2007, its market share growth rate dropped to 4.3%, and its operating margin to 8%. In 2008, American was able to stop the share loss. Its market share growth was 0%, but its operating margin fell to negative 6.1%. In 2008, Southwest's market share growth rate improved to 5.7%. Its operating margin fell to 4.1%. Even after 2 difficult years, Southwest still had a strong competitive position and a big lead over American. Southwest's low costs continued to be an advantage. What does this tell us about lasting competitive advantage? Lower costs can be a lasting advantage, especially if they're low enough to let a company charge lower prices and enjoy good profit margins at the same time. Differentiation can also be an advantage, especially when a company has a unique brand and continues to invest in that brand. Cost and differentiation can be advantages regardless of size. Bigger is not always better. Difficult industry or economic conditions are the best test of any advantage. Really strong companies stay ahead of their competitors even in hard times. When the going gets tough, the tough get going.